With the two chapters that we've been discussing on capital markets and the pricing of risk and talking about optimal choices of portfolios, I want to go through some of the problems that we could solve with some of this data, some of this information. We saw a slide that talked about how $100, what that ended up returning to or earning after 88 years. So from this, we can calculate the holding period returns for these particular investments. So let's think first about this $480,000 here, which is the S&P 500. If you put that into the holding period return calculation or spreadsheet, $100 turns into $480,000 in 88 years, and that roughly earns a 480,000% return over that time frame. But when you annualize it, that's a 10.11% rate of return. What about a world portfolio? It only grew to $187,000. So in that case, its annualized return is 8.94%. And for bonds, we can see that's even less, around 6.38%. So again, we can calculate the holding period return. The net return, or the actual return, we're not as interested in as we are the annualized return. So this is where we get the statistics from a couple of the tables that we looked at that talk about the rates of returns on financial instruments over time. We also had talked about something called standalone risk. Now we have two portfolios or two assets to talk about, X, Y, and Z. We paid $100 for this stock. Here are the estimated future prices, the rates of returns on those prices, and this is the probability of those events occurring. Likewise, we have another stock, ABC. We again have their current price. We have the estimated prices per year, returns, and their probabilities. So let's see what happens when we put these numbers into a spreadsheet. So the spreadsheet that we're going to use is called Standalone Risk. And Standalone Risk requires us, in the yellow boxes here, input the probabilities, input the returns, and it will calculate the statistics for us. As we can see here, asset A is 3.8%, asset B is 2.53%. You look at the risk, 3.49 is A, 6.95 is B, and their coefficient of variations 0.92 and 2.75. So we can see that B has a lower rate of return, but it has a higher amount of risk. If you look down through the statistics, the 95% confidence interval, you can see that there's a 95% chance that assets A's return is between -3 and 10, and there's a 95% chance that B is between -11 and 16. This also calculates the correlation and covariance, and you can see here that the correlation is -0.99, covariance -0.0024. But we can see what this negative correlation, what that means is, if we combine these assets together in a portfolio, we will see substantial diversification of risk because they are so unrelated, in fact, almost perfectly negatively correlated. Next, let's look at some historical data. I've gathered some monthly prices for Coors, TAP, Berkshire Hathaway's Class B stock, and a stock index, Wilshire 5000. Here are the prices, and again, using the holding period return, formula, I calculated the monthly rates of returns on these investments. What I would like to do is talk about the statistical measures, right? Give me some information about these particular assets. So what we have is the spreadsheet here is the historical data analysis worksheet. When you copy and paste the returns in here, you do have to change the data points to 20 so it reflects all the numbers, because the 20 is in some of the formulas. But as you can see here are the rates of returns that we copied from above. The mean for cores was negative 2.6. Berkshire Hathaway averaged 1.58% per month, and the Wilshire was 1.05. You can also see the standard deviations. We see that Coors has the highest standard deviation. And we also see that, relatively speaking, it appears that Berkshire Hathaway has the greater coefficient of variation. So it shows as relatively riskier. If we look at the correlations, we can find that the correlation between Coors and Berkshire Hathaway, stocks A and B, is 0.308, and the correlation between A and C is 0.348, and the correlation between B and C is 0.815. So if we wanted to combine these stocks together, which two would be better fit? Which one would provide better outcomes as far as reducing risks? And again, we could find out that the two on the right here, right, combining A and B or A and C would provide a greater reduction in risk. Not necessarily a greater return, but a greater reduction in risk. How can we calculate the 95% confidence interval? Again, here we have our formulas. We need the standard error. That's just standard deviation divided by the square root of the observations. And then the 95% confidence interval is the expected return plus or minus 2 times this standard error. So the standard error for TAP is 1.12, and the 95% confidence interval is somewhere between negative 0.44 and negative 4.92. So again, we can find out and speak relative terms. What is it? What is the range? Where do we think the returns ultimately would be maybe 1 year from now? For the 95% confidence interval, also for Berkshire Hathaway, it's somewhere between 3 and 0.12. Now, the nice thing about this 95% confidence interval, essentially it says that you're 95% sure. In fact, 95% and another 0.25 on the far end. So you're 97.5% sure you're not going to lose money if you buy Berkshire Hathaway. And likewise, if you could invest in this stock index, right, there's a 97.5% chance that you won't lose money, because it'll be somewhere between 0.09 and 2.01 will be returns on the Wilshire 5000. Another question that we might have has to do with calculating expected returns. So we have Disney has a beta of 1.18. The risk-free rate of return on a 30-year T-bond is 3.12. If we can assume that the average return in the stock market is 10%, we also know that the beta of McDonald's is 0.73. We want to answer the following questions. We do all of this on the portfolio beta and returns spreadsheet. What are the expected returns? If you input the risk-free rate, the average return in the market, and the beta, we see that you would expect on average to get 11.2% if you invested in Disney, and you would expect 8.14% if you invested in McDonald's. The second question talks about the market risk premium. The market risk premium is the difference between the average return on the market and the risk-free rate. So 10 minus 3, using this kind of just averaging, right? 10 minus 3, that's roughly what, 6.88% is the risk premium, or the market risk premium. What is the risk premium of the stock? Now you take the expected return and you subtract the risk-free rate. So 11.2 minus 3.1, that's 8.1 is the risk premium if you invest in Disney. 8.1 minus 3 is roughly 5% if you invest in McDonald's. What happens if the stock market changes? What will you expect to happen to these stocks if the stock market changes? If the stock market changes by 3%, we would expect Disney to go up by 3.54. It goes up by more than what the stock market did. Why? Because it's riskier than the stock market, and the market risk premium here, the risk premium is standardized based on the riskiness of the individual asset. With respect to McDonald's, since its beta is less than 0.73, when the stock market changes, it will change just like the stock market changed, but it will do it to a lesser extent. So again, we can see that risk, measured by using the definition of systematic risk, is measured by beta, and we can plug it into formulas and create estimates, if you will, of what returns you should expect to get if you invest in those assets in the stock market. Chapter 11 was a little bit more theoretical and talked about making optimal choices, if you will, and how we analyze that kind of data. So the first thing we have is we have a couple of stocks that we want to invest in. We're going to buy 100 shares of hemp stock and 100 shares of TWMJF stock. At the beginning of the year, hemp was selling for 0.0225 cents a share, and the other stock was selling for $23.34. Let's assume that hemp rises to a nickel and the other stock increases to 25 cents. If the betas of these stocks are 3.47 and 3.37 respectively, what information can we gather from this stock? Well, the asset A, if you calculate the price, we'd have paid $2,250 for A, and we would have paid $2,334 for B. $45.84 is the total amount we spent, and the weights, roughly 49.1% in A and 50.09% in B. What are the rates of returns? Again, using the holding period return, we see that you actually earned 122% on A and 7% on B. So let's think about this. Which are you happier with? The 7% increase in B or the 122% increase on A? Remember, we have to figure out how much of this can you actually spend. What's 122% of 0.02 cents, right? I mean, this essentially went up 3 cents, right? Which really is a fairly low increase compared to the other one that went up almost $1.76 or $1.66 times 100 shares, right? So relatively speaking, how much in real dollars did we earn or increase? So this portfolio should have earned 63% based on this change. The portfolio beta is 3.419. So now the question is this a decent rate of return or not? Well, if this portfolio has a beta of 3.41, the risk-free rate's 3.12, average return on the market's 10, we would expect that this portfolio to increase by 26%. However, it increased by 63%. So this portfolio is definitely outperforming what we would expect to happen if we'd invested in this portfolio. So we're actually getting a very good return. Again, what would happen if the stock market increased by 3%? If it increased by 3%, with that beta 3.419, we would expect an increase of 10.25% again on the rate of return, or on this portfolio's return. The next thing we want to do is, again, look at some real data. In this case, I'm looking at monthly returns on some stocks. We have 6 months returns that we have, and I've input here the returns for those stocks. And you can see it's 1.86 for A is the return, average return for B is 1.6, and C is negative 1.1. Here are the risk levels. We can see that B has the least amount of risk, C has the most amount of risk. The correlations, as you see here, is 0.702 between A and B, 0.707 between A and C, and of course between B and C we also have this negative 0.63. What we can do then is look at portfolios. If you put half of your money and half of your money in A and B, what would happen? You'd get a rate of return somewhere in between the two, 1.73. But look at the risk. The risk dropped below the riskiness of either one of these assets. Why did that happen? Well, it happened because the correlation was actually negative. If you look at half of money in B and half of your money in C, again, we get a rate of return that's somewhere in between the two, but now we also have a rate of return, or a risk that's also somewhere in between the two. So we receive some reduction in risk, but because it is a positive correlation, we said also that there's not a tremendous amount of risk because of the positive correlation. The fourth portfolio that I have here, I also input the potential of borrowing, right? Using a short sale or borrowing some money. So if we borrowed half of the money that we had and took that amount and reinvested in all the rest of our money, how would that affect the portfolio? Well, C is the portfolio that I'm borrowing against. So again, if you're borrowing, which is a negative kind of investment, and you earn a negative return, that is an overall positive rate of return for your portfolio. So you can see when I short sell this, we're actually going to earn a higher rate of return than is possible with any of the other assets. So it's a cumulative effect. And of course, we have the 3 assets. The total risk is about 2.42%. So again, the purpose of this is to show how correlation has an impact on risk, and also how the potential of short sales can help us with understanding how portfolios can earn extra money if we borrow against certain assets. If we take those same assets and we plug them into another formula here we have our returns. Here's the standard deviation, calculated variance. Here are the beta factors for this portfolio. Here's the correlations, again, all the stuff we calculated. In the end, we're going to find out that this portfolio has a return of about 2.669%. That's what it earned. What would we want to earn? Well, based on a portfolio of 1.219, which is the portfolio here, we would have expected to earn 11.5%. And of course, you can see here that we did not earn that. We actually earned much less than that rate of return. So we would, in this case, we'd say maybe we don't want to invest in this because it's not going to give us the same rate of return that we really were looking for. So again, this is just another version or another way of looking at the same kinds of investments, the same types of questions based on invested dollars, returns, expected risk, etc. There is a spreadsheet that's also available that can help us calculate the correlation between two sets of data. If you look here under prices, these are the prices for two assets. Next to that, we've calculated the rate of return. Again, this is with the holding period return formula. It calculates the average returns, the standard deviations, and of course it calculates the correlation. So the correlation between these two assets is 0.959. What that means is it's almost a perfect positive correlation. So if you combine these two assets together, you will get some diversification, but very minimal amounts of diversification because of the high level of relationship, how closely related these two assets are. One final question that we might ask is, if you know the correlation, we know the statistics, can we calculate covariance? And again, other than the mathematical question, it really isn't something that you necessarily would want to do. You rarely know the covariance. You rarely want to know the covariance. The thing you want to know is correlation. So for these three assets, I've input the correlations, the standard deviation of the first asset, standard deviation of the second asset, and here's our formula. We take the correlation times standard deviation of A times the standard deviation of B. So the covariants are listed here on the right. And again, other than the fact that we can calculate this, and other than the fact that it basically shows us that the one in the middle here has a positive relationship and the other two are negative, covariance really gives us very little information other than it's positive or negative. It has really no impact on value, on the power of the relationship. Again, if you can see here, -4 and -6, and when you look at it, you know, the correlation is negative, but really it's kind of backwards. Say, well, why is this number, covariance is smaller, but the correlation is bigger in magnitude wise? Why is that? Well, again, it's because covariance just measures plus or minus. Correlation gives us a standardized measure of power, if you will, of the relationship. So that's the basic kinds of problems that you might find from chapters 10 and 11 in this course.